So buying a home is exciting, but let's be honest, it can be overwhelming too. This is the largest financial purchase you'll probably ever make, and for many buyers, they don't even know where to start. So in today's video, I'm going to break down the top 10 essential home buying steps, and this is coming from real life experience from helping hundreds of buyers go from confused to confident homeowners. So grab a notebook, grab a cup of coffee. This is going to be a long video, but by the end, you'll know the entire home buying process from start to finish, so let's get into it. So step number one is you need to have a plan for your finances in place, and this is what all you'll need in order to get approved by a house. So there's really three main sections or three main pillars that you need. Number one, you need to have a credit score. Minimum credit score is a 620. Now, you will see other banks advertise that you can go down to a 500 credit score, but here's what they don't tell you. You're gonna get killed on the rate and the fees when you have a lower credit score. So really that benchmark is gonna be a 620. And really your credit score impacts the interest rate that you are getting. Number two, you need to have income. Now, income is one of the most important out of these three, one of the most important pillars. And you'll need to have a 2-year work history. Now, you don't need to be in the same line of work. You don't need to be at the same job for the last 2 years. You just need to have had a job for the last 2 years. And your income determines what we call your buying power, or how much you get approved for. And then number three, you need to have some savings. So you'll need to have money for down payment and closing costs. Now, even if we're able to get you like down payment assistant program, a grant program to cover the down payment, and even if the seller pays for all of your closing costs, you need to still have some money saved up in order to show the bank that you have what's called reserves and that you can make your next mortgage payment. Then step number two is you want to actually get pre-approved, because you don't want to skip to looking at houses and fall in love with the house that you can't actually afford to buy. So what they will need in order to pre-approve you is they're going to need your documents. If you're W-2 worker, you get a W-2 at the beginning of the year, they're going to need the last 2 years of that. They're also going to need your last 2 years of pay stubs. Now, if you work a 1099 job or you're self-employed, they're going to need your last 2 years of tax returns, and then they're going to ask you for bank statements, driver's license, basic things like that. Then what the loan officer is going to do is, based on your loan applications, your documents, where your credit score is at, that's going to determine which loan type that you'll get approved for. And there's really 4 major types of loans. Number one, you have conventional, which conventional is best for those with usually a 700 plus credit score. And for first time home buyers, minimum down payment is 3%. Then you have an FHA loan, and those are really good for those with a credit score in between like 620 up to 700, and minimum down payment is 3.5%. You can only use this to buy your primary residence. These are all 3-year government loans. Then you have a VA loan that's for veterans or active military, 0% for the down payment. Then you have your USDA home loans, and those are for buying a house in the rural or outside of the city limits. Again, that's for 0% down. Then from there, when you actually get pre-approved and you have that consult with your lender, they're going to tell you exactly how much your buying power is or how much you're pre-approved for. They're also going to go over which loan type is going to be the best, and if they're really good at their job, they're going to give you your options and tell you why which loan type is better for your situation. Also, they should be giving you an estimated monthly payment so that you know with this amount of purchase price, this is going to be the monthly payment, to make sure it aligns with your personal budget. And then they're also going to tell you how much cash to close or how much money that you will need to bring to the closing table. So if you're confused about which type of lender or company to go with, here's really the difference between a mortgage lender, a broker, and a bank. So a mortgage lender, they really work for one company. They represent their one company. And so because of that, you're stuck with whatever rate, fees, programs that company is offering. Also, if you do get denied, then you have to start over, get your credit pulled somewhere else, do another loan application. Now, I used to be a mortgage lender myself, so I know how they work. And these are big named companies like Cross Country, like Rocket Mortgage. These are mortgage lenders. And then number two, you have mortgage brokers. And mortgage brokers, they are not tied to one single bank. And because of this, they can shop your rate with one credit pull, with one application. They can shop the rate for you with all of the different banks and lenders that they're in network with. A lot of times, brokers have a lot more flexible options and a lot more programs because of this. And if you do get denied by one bank, they can easily start your file over with another bank. You don't have to do another credit pull. You don't have to go somewhere else. They just easily transfer. And this is what I switched to. And number three, you have a bank. And a bank offer other financial services, not just mortgages. And because of this, mortgages aren't their bread and butter. So they really pick and choose who they want, which is why they have a lot stricter guidelines. And again, if you get denied with the bank, then you have to start over someplace else. Then step number three is you need to find a realtor that's going to represent you as the buyer, because the seller has their own realtor that's working for them. And the whole job of a buyer's agent is, number one, they're going to be the one that's going to be finding you and showing you the property. They're going to be the ones that's going to be negotiating and writing offers on your behalf. They're also going to guide you through the inspection, and they're going to help overall. They're there to help protect you throughout the contract, throughout all the contingencies. Now, how these realtors get paid is usually they get paid from the actual seller, so it shouldn't be an additional cost for you. However, that's not always the case. So you need to ask up front, hey, if the seller is not covering your commission, how much do you charge? Then they're going to ask you to sign certain documents. So number one, what they're going to ask you is they're going to send you over, it's called a buyer's broker agreement, and that's going to lay out how long you're going to be working with that agent. It's going to also put in writing how much they charge if the seller does not cover their commission. And it explains compensation, it explains representation, and make sure that if you don't understand something, make sure you ask. Also read through it by yourself. If the realtor does not explain things to you, that's a red flag. Because I actually had a client reach out to me. She found me on YouTube, and she was confused about this buyer broker agreement. The realtor would not answer her questions about it. I ended up reading through it with her, and in that form, it said that if she did not find a house within that time period that she was working with that agent, she's going to have to owe him $1,500. She didn't realize that. So make sure you read everything. Also, make sure if you do not have the money to cover the realtor's compensation, make sure you tell them that up front. Tell them, hey, in my situation, I need to go with a house that the seller is going to be paying for your commission because I don't have enough funds to cover that. So make sure everything is clearly communicated up front. So now that you're pre-approved, you found a realtor, now step 4 is, this is where you're going to start house shopping. And this is really the most fun part. So what you want to do up front is build out your needs versus wants list and make sure that everyone that's going to be buying with you is on the same page. So be really clear about the needs are going to be what your non-negotiables are. If it's like bedrooms, amount of bathrooms, things like that. Your wants is what you can live without. And you'll want to really smart shop. So understand your area. Before you start lining up houses, go to open houses in different areas so you really understand the different neighborhoods and see if you like that area. Because remember, location matters most when it comes to real estate, because you can upgrade a house, you can really knock a house down, but you can't change its location. And really, you want to make sure that your realtor and your lender is working as a team. And because of this, you want to consult with your lender before you start writing any offers to make sure that those numbers align with your monthly payment goals and also your cash to close as well. Then once you find a home that you like, then step 5 is you're going to make an offer on that home. And you'll want to, a lot of times you want to act fast during this time because homes, when they're priced correctly, they go off the market pretty quickly. And sometimes, a lot of times I see buyers lose out during, they go see the home and then they're unsure and they don't make an offer, then they lose out on the home that they really wanted, but they were just too scared to pull that trigger up front. Now, a strong offer, an agent is going to help you structure this. There's really several key components when it comes to an offer. Of course, you have the price, you have the closing date, Some sellers want a really quick close. Some sellers don't really care. 2, you have your inspection period. Then 3, if you're going to be offered any closing costs, any repairs, and overall contingencies, these are all something that the realtor can help negotiate with. And what ends up happening once you submit an offer in, the seller really has 3 responses. Number 1, if they accept it, that's great, you're under contract. Number 2, they can just reject it outright, which normally means the deal is done, they're not interested. Or if you do get a counter offer, that's when there's negotiations, they are interested, and you can negotiate on those terms. Then once you're under contract, that next step 6, is going to be your inspection period. And this is when you're really there to figure out if you're going to be moving forward with the home or not. Because the home inspection is normally done within the first several days of the contract. It can cost anywhere from $400 to $600, which the buyer pays for it out of pocket. And the home inspector, they look at the overall condition of the home from the roof to the foundation. And it's not, when it comes to the report, it's not a pass or fail, it's more of a conditions report. So they're going to line item, give you pictures, tell you exactly what needs to be changed or repaired right now, what can wait, what might be future repairs coming. And if there's any major issues that the general inspector sees, let's say when it comes to like foundation cracks or issue, they're going to call it out. And that's when you'll want to get more specific inspections done from people who are licensed in those professions. Then the inspection period, normally this whole period is about 7 to 14 days. It really depends how the realtor writes it in the contract. And again, this, based on what the inspections come out with, you then can decide if you want to move forward with the property or not. Again, negotiations can start over at this time, and you can use that inspection report as your leverage if you want to get some money off of your closing costs, some money off of the price of the home, or if you want them to actually do some repairs itself. This is when all of that is decided. Then step number 7 is you're going to go through underwriting with the bank, and this kind of goes along the same time as when you're doing the inspections. And the bank is going to send you what's called your disclosures that you'll need to sign. And this is going to show you their government forms that has to get shown to the buyer. And it's going to show you exactly the breakdown of the monthly payment, the interest rate, all of the fees and closing cost. Then the overall process is once those are signed, you want to move forward with that bank, then you get moved into what's called underwriting. And underwriting is basically there to just verify all of your information, make sure that you can handle the payment, your income is correct, credit score looks good. And what they're going to do is you're going to get a loan approval with conditions if the underwriter signs off on that. Then the conditions, in order to get that final clear to close, you'll have to satisfy whatever other conditions, whatever other forms or documentation the actual underwriter wants. Those are called conditions. And once you get everything satisfied that the underwriter is asking for, that's when you get your actual clear to close. Then step number 8 is going to be an appraisal. And the whole purpose of having an appraisal done is it just confirms the home's value. And the bank itself, they're actually going to send out their own appraisal. And there's really 3 outcomes that can happen. Number 1, it appraises at the home's value, which is great. Loan moves forward, nothing changes. Number 2, if it appraises higher, same thing, nothing changes. You yourself, you just walk in with instant equity. Doesn't mean you need to change the purchase price to a higher amount. Then number 3, if the appraisal price comes in lower than what you're buying it for, then you have to renegotiate with the seller. They can either drop the price in order to meet that appraised value, because the bank is only going to lend you how much the home is worth, which is based on the appraisal. Or 2, if you can't come to any negotiations, this gives you an out and you can walk away. And the reason why the appraisal matters is because, number 1, it protects you and the lender itself. They want to make sure you're not buying the house for less than what it's worth. 2, the appraisal will also take a look at do their own inspection, take a look at the condition of the home. And if any health hazards, any issues that they see, they're going to call it out, and the seller is going to have to make those repairs before you close on the home. Then once you get the clear close for underwriting, the appraisal is good, then it's time for closing day. And closing day, this is where you're going to sign all the docs to make it actually official. And this takes place, generally speaking, at the title company. And you're going to need generally 2 forms of ID. They're going to have you sign 100 pages of documents. So the closing process takes anywhere from 1 to 2 hours, just depending. 2, the cash to close. This is when you're going to wire the amount you need for the down payment and for closing costs. You're going to wire that to the title company either a day before or the day of closing. And then at the end, once they verified the funds, they got all the funds from the bank, from you, everything is signed. That's when you actually get the keys and you're officially a homeowner. Then step number 10 is what happens after closing. So your first payment, usually you get to skip a calendar month before your first payment is due. So let's say that you close in February, your first payment won't be due until April. You get to skip March. You get to, that gives you enough time to save up a little bit more. And where you're going to be sending these payments is about anywhere from 2 to 4 weeks after the closing takes place. The bank is going to send you a letter in the mail. It's called your first payment letter. And that's going to tell you exactly where you're going to set up to make the payments. And it's also, when it comes to home ownership, the actual first payment or your first payment isn't due like it is when you have rent, where it's due on the first day of the month. And if you don't have it by day 2 or 3, it's considered late. It doesn't work like that when it comes to home buying. Normally, you have anywhere from the 1st through the 14th of every month to make that payment, and you can set it up on whatever day you'd like. There's a lot of different options when it comes to that. And if you're planning to buy a house in 2026 and want to know exactly how much is your buying power, click on the link in the description, schedule a call, and I'll be in touch.